Dan is on the line from Edmonton. Go ahead, Dan.
Hi there, and thanks for taking my call. I was just wondering about silver wheaten. I've held it for a while, and I'm just wondering why on a day like today, like when silver is up, it seems to be dropping. Is there any particular reason for that?
Sure. So Dan, that's a good question, because I think lots of people are asking these questions on the really tough days when you see the gold or the silver higher. Some of the producers are not following along, and I think for some time it was concerns around, there were some big concerns around costs of production and bringing mines into production. But the big issue is on a day like today, really, you could classify this as what they'd call a de-risking day, and this is a day where people are taking down their risk exposures because I think right now the big concern are the macro concerns in the market. And if you look at the sources of return in a stock, you've got market impact, you've got sector impact, and then you've got business characteristics. Specific business characteristics really only account for about 20% of return over time. So 80% of return comes at the hands of market and sector. So right sector, the difficulty is you're facing a real tide in the market today. People are not buyers of risk assets. And so on a day like today, you can generally expect, even if the metal is higher, for the equities to have a tougher time. Now, having said that, I think that there's nothing wrong with silver wheaten. And frankly, on a relative basis over the last 2 months, silver wheaten has been behaving much better than the market. There have been some other precious metals companies that have acted a little better, but I think that you're fine with it. It's within a whisper of the last couple of months' highs.
That's interesting. Only 20% of returns come from the actual characteristics of the company.
Yeah, and that's an important one, because if you realize that most managers are hired to be in an asset class, so it's not their decision whether to be in stocks or not, they're to be invested, and they're expected to look a bit like the index so their sector weights don't deviate too far, so they make their money by picking the stocks, and I get it. Our view is private investors hire a manager to do two things. One, find good ideas, but second, manage their exposure based on market conditions. So there's a time to be more invested and a time to be less invested. You've got to pick your spot sector by sector, and those things do have a big impact.
We've got an email from Kevin in Montreal. The subject is Finning versus Toromont. I've been vacillating between the two stocks. Both have exposure to infrastructure and to mining. Finning also has exposure to the oil sands. What would be your guess preference for long-term growth and dividends?
Okay. So this is another really good question. So first of all, let's talk about the industry itself. The neighborhood's a bit tough right now. Industrial equipment's been pretty beaten up over the last few weeks after being very good for the last 18 months. So you're facing a little bit of a tide there. When you put Toromont up against Finning and you look into the businesses, I think that probably you have to come down on the side of Finning. So you have to like the industry, and I think right now there's some economic risk there. But Toromont more focused on Ontario, so there's some mining that they can focus on, but it's more construction and so on. Whereas Finning has the oil sands, and it's Alberta. They also have South America, where there's a ton of mining work and infrastructure work being done. So given the choice, I would prefer to be exposed to the geographies that make more sense. And I think, unfortunately, right now, because of where the Canadian dollar's been in manufacturing, it's a tough spot to be in Ontario specifically. So Finning, I have to come down on the side of Finning.
Kerry is on the line from Richmond Hill, Ontario. Go ahead, Kerry. Hello, Kerry.
Yeah.
Hi, Kerry. What's your question?
Yes, I'd like to know if he has any comments on PCP, Precision Cast.
Sure.
Thank you very much.
Thank you.
So Precision Cast Parts is a company that we own. It's trades in New York. It's a company that makes parts that go into jet engines and other types of big engines. Now, what's interesting about it is that we believe that we are in a long cycle of replacement for aircraft, and specifically looking for more efficient engines. So some people choose Boeing, which has its problems with defense. Some people choose Airbus. I don't think you have to choose. You can have Precision Cast Parts, which supplies both of them. And so we think that this is probably a longer cycle, and it's certainly being impacted a little in the market. Stocks consolidated a lot around $140, so there's pretty good support around $140, which is around where it's trading now. So technically it's still okay, and the earnings are very strong. So I'd be a buyer of the stock. Having said that, again, I'm a little cautious market-wise currently.
Mike is on the line from Vancouver. Go ahead, Mike. You're on the air.
Good morning.
Hi.
Wondering how BCE is going to do in the next year or so.
Great. So, Mike, we talked at the beginning about focusing on what people care about now, and whether you're an endowment fund or a pension fund or an individual investor, everybody is looking for yield, which gives you some yield support. You know, Mr. Bernanke came out a week ago and said interest rates likely will stay at zero until through mid-2013, which means it gives you a very simple decision. You know, what do you want to make versus zero in fixed income, right? You don't have to worry about rising rates competing or crowding you out. So the thing that we really like about BCE is it's got this great dividend. It's got very steady cash flow in the business. They've done a great job in restructuring the business. So whether you're looking at BCE or TELUS, both I think are in the right camp. Telecom was one of the 5 or 6 sectors, period, that I would be buying stocks in right now. And BCE is one of our biggest positions.
BCE, of course, the parent of BNN. Steve is on the line from Mississauga. Fire ahead, Steve.
Hi there. I just wanted to ask what David's view is on gold. Are we looking at the precious metal going further than even today? And more importantly is, why are the stocks not catching up to the price of gold? So, I have a few gold stocks, and in fact, I wanted to ask David, like, what are his favorites in the small cap? But anyway, I'm in Xtor, XG, and I just wanted to see if he agrees with that was a good pick. Thank you. Bye-bye.
Thanks.
So, Steve, on gold, we have a trend, as Dennis Gartman would put it, from the lower left to the upper right. Gold does look like it's going higher. This is benefiting from the current environment where really every government's trying to devalue their currencies, and people are seeing this as some store of value. Of course, something that's moving higher like this can correct at any time, but we are believers at this point. We own more physical gold than producers. So we run an ETF portfolio that's focused in the actual gold ETF as opposed to the producers. In our equity portfolios, gold producers would be our biggest weight at about 15%. We focused on mid to larger size producers. The big knock on them recently has been that the cost of bringing in a new mine has gone up a lot. And in fact, really the rise in the price of gold has not been offsetting that to enough degree. The second thing is that oil prices have been high. Now, oil prices are backing off, and you're seeing the gold stocks start to lift. So we would say recently you've seen much better price performance in the gold producers. We own a number of them. Our focuses would be in companies like Yamana, Eldorado, Allied Nevada. We have a position in Kirkland Lake. These are all behaving well, and I think you want to stick with the stronger relative strength companies.
We'll be right back with David Burrows of Barometer Capital Management answering your questions on North American large caps. The number 1-855-326-6266.